Welcome back to the Deep Dive. Today we're looking at WEC Energy Group, ticker WEC, right after their Q3 2025 earnings. And this one is a fascinating story. You have what is probably the strongest long-term growth story in the entire regulated utility space. And yet, the stock actually dipped right after the announcement.
That's the whole puzzle, isn't it? The divergence is exactly why we're digging in today. Management was, incredibly bullish. They raised guidance. They unveiled this record-breaking capital plan. Our mission here is to figure out the sheer scale of what they've locked up, and maybe more importantly, why the market decided to punish them for it.
A classic short-term versus long-term story.
Exactly. Short-term financing needs hitting a generational growth story head-on.
Okay, so let's set the stage with the quarter itself. The results were solid. They delivered GAAP EPS of 83 cents, which just beat the consensus of about 0.01 cents.
Right. And revenue was strong, too. Came in between $2.10 and $2.14 billion.
Which was way ahead of the $1.91 billion the street was expecting.
Yeah, the core business is humming along. Retail electric deliveries were up 1.9% year over year. Management even affirmed their full-year guidance for 2025, that $5.17 to $5.27 range. So fundamentally, nothing's wrong.
No, the business was stable. This wasn't a recovery story. They were just, getting ready to announce a massive change in strategy.
And that change is the capital plan. This really is the main event.
It is. They unveiled this huge 5-year plan for 2026 through 2030, totaling $36.5 billion.
Which, just for context, is an $8.5 billion increase.
An $8.5 billion increase. That's a jump of more than 30% over their last 5-year plan. It's huge.
It's a profound statement.
Yeah.
It's basically WEC telling the market they're not a sleepy utility anymore.
They're an infrastructure platform for the AI boom.
And that investment, it translates directly into some really industry-leading growth targets. They're projecting their asset-based CAGR at, about 11.3% over the period?
And that flows down to the bottom line. They raised their long-term EPS CAGR guidance to 7-8% through 2030.
I mean, that level of visibility, that growth rate,
yeah,
you just don't see that in the regulated utility space. It's almost unheard of.
So what's driving it? Because it's not just regular economic growth.
No, not at all. It's load growth on a scale that is, frankly, unbelievable. We're talking 3.4 gigawatts of new demand by 2030.
And that's 1.6 gigawatts more than what they had in the prior plan?
Right. And this isn't some theoretical demand. This is coming from the biggest macro trend out there, hyperscale data centers.
Anchored by 2 gigantic confirmed projects in Wisconsin.
Shovels in the ground projects. These are real commitments.
So let's start with Microsoft. They're building that huge data center complex down in Mount Pleasant.
And making really good progress on it. Management even confirmed Microsoft announced a second phase.
Second phase.
Yep. Another $4 billion in projected investment. So just that area, south of Milwaukee, is supporting 2.1 gigawatts of demand growth.
Just that one spot, that's a huge chunk of the total 3.4 gigawatts right there.
It is. And then you have the Vantage site north of Milwaukee. Vantage Data Centers is building what they're calling the Lighthouse Campus.
And WEC is providing the power for that.
For about 1.3 gigawatts of demand over the next 5 years. Vantage is expecting to pour $15 billion into that site.
And the really high-profile part of this story
is that the Lighthouse Campus was recently linked to that massive Stargate partnership.
The one between OpenAI and Oracle.
The very same. So WEC is quite literally building the power plants for the future of large language models.
I'm just trying to wrap my head around the scale here. 3.4 gigawatts of new demand. What does that even look like in terms of, actual stuff they have to build? Is there any concern about getting the labor, the materials, the specialized engineers to pull this off in just 5 years?
That's a real execution risk, for sure.
Yeah.
But the capital plan shows how they're thinking about it. That $36.5 billion is going into a few key buckets. First is generation and reliability. They're putting an extra $3.4 billion into modern, efficient natural gas generation. Specifically, combustion turbines and RECIP units.
And RECIP units, remind me what's special about those.
So RECIP stands for reciprocating internal combustion engines. And they're critical because they are highly dispatchable.
Meaning they can turn on and off really quickly?
Instantly. They can ramp up to meet those sudden spikes in demand from, say, an AI training model, which older plants just can't do.
So it's about reliability for that specific type of customer.
Exactly. And at the same time, They're bumping up their renewables and battery storage investment by $2.5 billion to help balance the load.
And transmission, you can't just generate the power, you have to move it.
Transmission is huge. They're investing another $4.1 billion into the American Transmission Company, ATC. That's a $900 million increase.
And WEC is a majority owner of ATC, right?
60% owner.
Yeah.
So they benefit directly from building out the grid to get all that power to the new data centers.
And it's not all just for the big tech companies. They're also upgrading the regular distribution network.
Absolutely. There's a $2 billion increase for that. A big chunk is for that pipe retirement program in Chicago.
The one where they're replacing all that old cast iron pipe?
Over 1,000 miles of it. It's critical safety and maintenance work that's mandated by the state.
Yeah.
So the plan is this blend of, futuristic AI capacity and just essential modernization.
Okay, so the long-term story is rock solid. But let's get to the market's reaction. The stock dipped. Why? It all boils down to the short-term financing, right?
It all boils down to dilution. That's the word of the day. To fund that extra $8.5 billion in spending, they said the new capital will be funded with about 50% equity.
50%. And that translates to?
Roughly $5 billion in new common stock being issued over 5 years, plus another $2 billion in what they call hybrids, or junior subordinated debt.
Wow. $5 billion in new stock, that's a staggering amount for a utility. Your typical utility investor is looking for stability, dividends, not massive dilution.
It completely changes the profile, and it starts right away. They're planning to issue between $900 million and $1.1 billion in new equity in 2026 alone.
So the pain starts immediately.
The pain starts immediately. Now, management says they have plenty capacity for the debt side, so no ratings risk there. But the common equity is what stings.
So let's talk about this equity dilution delta. This is the key for understanding the market's reaction, I think. WEC is promising 11.3% asset growth, but only 7 to 8% EPS growth. Where's that missing 3 or 4% going?
That gap is the price of admission. It's the cost you pay today for that guaranteed growth tomorrow. Think of it like this. The company's physical asset base is growing by over 11% a year. Phenomenal. But to fund it, they have to sell all this new stock, creating more shares. So when you divide the earnings by a bigger pool of shares.
The earnings per share for the existing owners only grows by 7 or 8%.
Exactly. That 3 to 4% difference is the dilution. It's the non-cash tax investors are paying right now, and the market is pricing that in today.
And to add insult to injury, the growth isn't even linear. It's back-end loaded.
That's the other timing issue. Investors take the dilution pain now, but the full reward is delayed.
Sure.
The next 2 years, 2026 and 2027, will probably see growth in their old range, 6.5 to 7%. The real acceleration kicks in after 2027. So 2028 through 2030, that's when you'll see EPS growth closer to that 8% top end.
It just takes time to get these massive projects built and in service.
It takes time to get them into the rate base where they can earn a return.
Okay, shifting to the regulatory side. How do they guarantee they get paid for all this? The very large customer tariff, the VLC, seems critical.
It is absolutely vital. It's still under review, but it's important not just for the return they get, but for how it shifts the risk.
How so?
It's designed to make sure these hyperscale customers pay their fair share. So if a data center suddenly packed up and left, that risk doesn't just get dumped onto residential customers.
It protects the existing ratepayers.
It's a mechanism for safe, reliable cost recovery. And that's key.
And what kind of return are they asking for with that safety net?
The proposed ROE, return on equity, is in a range of 10.48% to 10.98%.
Which is a premium.
It's a premium over their currently authorized ROE in Wisconsin, for sure. And you need that to justify this kind of concentrated investment. I mean, by 2030, these data center assets will be 14% of their entire asset base.
And the next big thing to watch is the Wisconsin rate case next year.
Right, that's their regular biannual filing. We should see that late Q1 or early Q2.
Okay, one last risk factor, the Point Beach nuclear plant contract.
Yeah, a small uncertainty there. They have a contract with NextEra for that capacity, and it's secure until 2030 or 2033. But importantly, they have not included any capital to replace that power in the current $36.5 billion plan.
So there could be even more spending down the road.
Potentially. They said if they did need to replace it, it would be with gas or renewables, which implies another capital project that isn't even in this record plan yet.
All right, this is the perfect setup. Short-term pain, long-term gain. Let's put on our analyst hats. Time for our segment. This is not financial advice. And we have to say it. This is purely hypothetical, high risk, and definitely not financial advice.
Okay, so the pitch here is based on the idea that the market is just completely misreading this. It's valuing WEC like any other utility, focusing only on the dilution and ignoring the fact that they've secured this incredible best-in-class growth.
So what's the trade? What are we taking to the investment committee?
The trade is long WEC and short the utility ETF XLU as a timing hedge.
Interesting. A pair trade.
The thesis is that WEC's confirmed 7-8% EPS growth is just vastly superior to the mid-single-digit growth you'll see from the rest of the sector. So you go long WEC because of that $36.5 billion in visible projects, and you hedge it by aggressively shorting the XLU, probably in late Q4 or early Q1.
And why short the whole sector?
Because the entire utility sector is sensitive to macro shifts, rising rates, and right now the market is scared of dilution everywhere. So this trade tries to capture WEC's specific guaranteed outperformance while buffering against those broader sector-wide headwinds.
So you use the XLU short to kind of ride out the initial pain from WEC's own equity issuance next year.
Exactly. The belief is that WEC's unique story will let it detach from the sector long before that 2028 growth acceleration really kicks in.
A bold play, betting on a single company's execution over the entire sector's momentum.
It's a bet on confirmed load growth. Simple as that.
So to wrap this all up for you, the listener, WEC is in the middle of a massive transition. It's going from a steady, stable utility to a high capex growth engine for the AI boom. The stock is soft because funding that growth requires selling new stock in the short term, and that is the price of admission for securing this industry-leading growth rate.
And what really defines this moment, what makes it so interesting, is the sheer scale of that growth. That $36.5 billion plan is already a huge step change. But remember what management said. This plan only includes firm commitments. They still have 1,200 available acres at Port Washington, over 700 acres at the Microsoft site. So the question to leave you with is, how much higher could WEC's asset base and the financing they'll need for it actually go by the end of this decade? That potential upside isn't priced in at all.
A truly compelling thought. That's where we'll leave today's deep dive. We encourage you, as always, to review your own sources and connect those dots. Until next time, stay well informed.